keep doing that till the end of the semester here. So I want to just start out with a review from last time, okay? And the reason I want to review these particular slides is that this is our discussion of the statement of activities. And the statement of activities is, as you recall, like the income statement for a not-for-profit organization. And it turns out that as you review the questions for your practice midterm, we're going to see as we go through this that a lot of the questions leverage off of your understanding of the mechanics of this statement of activities. So it's important that we remember that. Now we had kind of, hopefully had a nice Thanksgiving, that we had that in the middle of our understanding of this. So a little bit you might have lost. So let's just make sure we're clear on this, and that we have our statement of activities. We get a contribution that comes into the not-for-profit. When we get a contribution, that is a non-exchange transaction because the donor simply does what? Gives us the funds and doesn't sit there and wait for any kind of service back or anything like that. So that's a contribution, and when the donor provides that contribution, it can come in unrestricted, temporary restricted, or permanently restricted. If it's unrestricted, it means what? That the donor has not imposed any restriction on those funds. If it comes in temporarily restricted, that means that the donor has restricted that, and they have called out to us that they want us to either use that for a particular, and remember we said purpose, or we have what? Equipment acquisition restriction, and that they want us to buy a long-term asset of some sort, or we have a what? Time restriction. They want us to hold that, say, CD for a while until it matures, right? Now, those are our categories of temporary restricted, but the organization can satisfy that by some action. And in the example that we went through in class, we had our little Save the Canines not-for-profit. Remember that finds dogs, homes, whatever, our made-up organization. And I forget who had agreed to give some money to Save the Canines. Did you decide to give some money to Save the Canines? Okay, still waiting for that, but that's all right. Okay, so what? Who got the 10,000 that comes in? And Yvette, you wanted to use it for what? The Fluffy program, right? We said, and so that came in temporary restricted. It had a program restriction on it. Now, what happens when we take that money in? We showed as temporary restricted, and the expenses were zero in our example because we hadn't spent any of the money the way the donor specified in that first year. Okay, so when we reported our change in net assets, and remember change in net assets is like our net income, we literally will report a net income by category. So in the unrestricted, our net income was zero because what? Nothing came in, nothing went out, right? In our temporary restricted, our net income was 10,000 because we got that money that came in and we hadn't spent any of it yet. And then in the permanently restricted, nothing happened. Now, permanently restricted means what? Somebody gives me a contribution, I don't know, $100,000, whatever, and tells me that I have to hold that investment forever, right? I have to hold the principal forever, and what? The corpus principal has to be held forever, but any interest or earnings off of that will, and they probably will say it should be used for some purpose, like a preschool program or something like that. So the earnings or increases in value would be what? Temporary restricted, or the donor may simply say, hey, once this thing appreciates in value and has earnings, you can use that money however, so those earnings would be unrestricted, right? Okay, so it could be either the earnings off of those are typically either temporary or they're frequently temporary restricted and sometimes they're unrestricted, but the principal is permanently restricted, right? And so those are our three categories: unrestricted, temporary restricted, permanently restricted. And remember we had what? The put mnemonic, put your pet in a not-for-profit. We satisfy the restriction through program, equipment acquisition, or time, right? Okay. Now, when we got to the next year in this little example, X2, we spent $6,000 the way the donor specified for us to spend that money. And so what happens when you satisfy a restriction, you have to show a reclassification adjustment on the face of the statement of activities. And remember, we showed the $6,000 coming out of the temporary restricted and going into the unrestricted. So now those funds are considered unrestricted, aren't they? And so if we're spending money, then we must have satisfied the restrictions. And so all expenses are automatically considered what? Unrestricted. And we reported that $6,000 as an expense in the unrestricted category. So we came up $6,000 through the reclassification adjustment. We came down $6,000 through the expense, didn't we? So our change in our net assets, our net income for our unrestricted is 0. Goes up by the reclass, comes down by the amount we spend, right? Okay. Then what? Then we reported the reclassification adjustment coming out of temporary restricted. And in this example, we assumed there were no contributions for year 2. So our temporary restricted came down. The change in net assets for our temporary restricted, our net income for temporary restricted was negative $6,000. Then that was what? Caused by the reclassification adjustment in this example, wasn't it? Okay. And nothing happened in the temporary restricted. Now, because we began the year with a what? $10,000 balance in our temporary restricted, that was what? Last year's ending balance, right? Last year's ending balance becomes this year's beginning balance. Now our ending balance in our temporary restricted is what? $4,000. Okay? Now, it's important that you understand the mechanics of the statement of activities, and you're going to see that the test questions that I'm going to be giving you may tell you the whole story. It'll sit there and say, Save the Canines received $10,000, of which the donor specified that it should be used for the Fluffy program. Save the Canines didn't spend any money in year 1 and spent $6,000 in year 2. And then the question will say, what should be reported as a contribution in year 1? What should be reported as a contribution in year 1? $10,000 temporary restricted, right? Or the problem may say, what should be reported as a reclassification adjustment in year 2? $6,000 being reclassed out of temporary restricted and into unrestricted. Or the problem may say, what is the net assets in the temporary restricted category at the end of year 2? $4,000 is right there in front of you, right? Okay. What is the balance in the unrestricted net assets in year 2? 0, right? Okay, so we could go through and we could look at any questions like that that'll tell you the whole story and then isolate one piece of this statement of activities. We're going to see that a good chunk of the questions take that approach. Okay? Any question? Okay, good. So as I recall, we left it at intermediary. I'm not going to go back through the whole lecture for for part 1. We left it, I believe, at intermediary, right? Transactions. I think it was right. Where am I? Right here. Okay. Everybody found that spot? All right, so let's go ahead and let's start to take a look at these intermediaries. Okay, let me explain to you what's going on here. So let's say Save the Canines is a small not-for-profit. And it's a little bit hard for them to really get a lot of inertia going with their fundraising because they're so small. And they make a decision that they're going to associate themselves with United Way. You ever heard of United Way? Okay. United Way is an organization that not-for-profits will affiliate with. And they'll say, United Way, you have name recognition, Most people have heard of United Way. They look to United Way to provide contributions to not-for-profits. And we're going to go ahead and we're going to hook up with you so that when you go out to, say, an office, say a CPA firm, and you're trying to get the employees at the CPA firm to contribute to not-for-profits, we want to be one of the ones that is affiliated with United Way. So when the brochure says which organization would you like to contribute to United Save the Canines is included in there, and someone looks and says, oh yeah, Save the Canines, that sounds good, I want a donation to go to them. Now what happens? At that point, United Way is going to get the money first, right? Now they're going to charge an administrative fee, I don't know, 5%, let's say, that they will charge that not-for-profit for having what? Having done that work to create the awareness that allows Save the Canines to then get the remaining 94%, right? But is that United Way's money other than that 6%? 5%, whatever it is? Is that United Way's money? That money belongs to what? Save the Canines. And so what happens? Since that money has been given to United Way, but it really belongs to Save the Canine, United Way is considered the recipient of that money. And as the recipient, they have to put a liability down for the money that is going to be passed to the beneficiary, in our little example, Save the Canines. So you've got the recipient, which is the entity that gets the money, and you've got what? You've got the beneficiary, which is who the money will ultimately be passed down to. Now, the beneficiary is going to be in a situation where they're going to say, oh boy, we just heard that United Way got some money that's for us. They will debit a receivable and credit a contribution because they know that money's coming down to them, right? Okay, so we've got what? Two entities. We've got a recipient. We've got a beneficiary, right? The recipient is the intermediary, the organization that does what? Gets that money initially, but the beneficiary is the one who will ultimately get that money. So what happens? The recipient records a liability because they know they have to pass that money down to the beneficiary. The beneficiary records a what? Receivable and a contribution for that because they know they're ultimately going to get that money. Now, we have this concept of variance power. And when you give money to United Way and you tell them give that money to Save the Canines, you have not given United Way variance power. They have no variance power. So if they do not have variance power, which means they really can't decide how to use that money, they record what? They record the asset, cash probably. They record the liability, and then what? The recipient will record a contribution and a receivable, right? Okay. Now, you could potentially give money to United Way and not direct to them what organization you want that money to go to. I don't know, you look at the list of not-for-profits and you say, you know, they all look so wonderful to me, and probably it's more like, yeah, I want to contribute, but get this out of my face. I don't want to sit here and figure it out. And so what happens? You just let them determine who of their affiliated not-for-profits they'll give it to, right? At that point, you have granted United Way variance power, haven't you? Because they can decide how to use the money. So what happens? At that point, United Way would debit cash, credit the contribution, and the potential beneficiaries do what? From an accounting standpoint, they do nothing. Maybe from a practical standpoint, they sit there and pray or beg and hope that United Way will give them a piece of that action. But what? There's no requirement for United Way to do that, so they make no journal entry. Okay? All right, so with that as an overview then, let's go ahead and let's take a look at the next slide. Where my little clicker went. Okay, let's take a look at the next slide all the way over here. Okay, I want to look at this one. And let's go ahead and read now sort of what I just gave you in that example. Okay, so when we have intermediary transactions like this, where you have what? You have a situation where you have a foundation, which is the recipient, and raises money for another not-for-profit organization, which is what? The beneficiary, right? So I'm just showing you in writing what we just discussed a second ago, right? Okay. And so what happens? If it is a without variance power situation where the money has come in, what happens? We're doing the recipient accounting here, the foundation. The recipient will debit the asset, probably cash, and credit what? Credit liability, right? For the money that they're going to have to pass down to the beneficiary, right? Now, if you look at this note right here, do you want a note? Do you want a piece of scratch paper or something to take notes on? You're okay without writing anything? Okay. Okay, when we come over and we have what? We have the follow next item B on next page. So we're going to follow which item on the next page? B. So you come over to the next page, and when you look at B now, this is without variance power situation, but now we're doing the counting for who? The beneficiary, aren't we? Doing the accounting for the beneficiary? The beneficiary in a without variance power situation debits the receivable, credits contribution revenue. So this is just putting in writing what we just said out loud, right? Okay? Okay, good. Now, there's the potential that the recipient will get the money with variance power. In other words, we won't tell United Way who to give it to, right? And if that's the case, now we're back up here dealing with the recipient's accounting. That's why I put recipient in that box there. We're dealing with the recipient's accounting. And if it's without, with variance power, the recipient does what? Debits the probably cash asset and credits what? Contribution. Okay, they're calling it revenue here. I need to point out something important. Revenue means that what? Means that the not-for-profit provided a service, didn't they? And they raised that revenue through that service. And we said revenues are automatically unrestricted. Contribution means what? That the person in a non-exchange fashion gave them that money and said, here, go do something good with the money and didn't expect something back in return. Okay, so we, Right. So, sorry. So we got contribution, which is what? Non-exchange. We got revenue, which is more like an exchange transaction, right? Okay? And contributions are going to be either unrestricted, temporary restricted, or permanently restricted. Hear me so far? But be careful, because there's a lot of the literature calls contribution, they'll call it contribution revenue, and that gets confusing because you say, is it a contribution or a revenue? If they put contribution in front of the word revenue, then it is what? It is a contribution. With me so far? And some of the literature is a little sloppy in that they just call it revenue because they're saying, well, they raised this money and now it's a revenue. They should have put here what? Contribution. Okay, that's more specifically called a contribution. But again, in the with variance power situation, the recipient does what? Recipient debits cash, credits contribution. The beneficiary does what? They're not even really technically not quite a, they're a potential beneficiary, aren't they? Okay, and so this potential beneficiary does what? Does nothing when the money's been granted to the recipient with variance power, right? So that's just pretty much what we just talked about there. You see it in that that little handout there, right? Okay. Now, as a side, just to explain this university and foundation thing that they're showing you here, university and foundation they're mentioning, sometimes a not-for-profit will set up a captive intermediary. And by that, they set up an organization that's whole job is to raise money for that one beneficiary. Okay? We call that what? The foundation, and many universities will do that. They'll set up a foundation who their whole world is just to raise money for the university. And then what? In that situation, almost any money that is raised by that foundation is automatically going to go down to the beneficiary, right? But there are times where maybe the foundation will do other works that would not necessarily benefit that one captive beneficiary. But for the most part, most of the money comes down. Okay. United Way is not a captive intermediary, not a captive recipient. They're sort of independent, aren't they? Okay, good. So let's go over And let's take a look at this really hard to read question. Okay, and I apologize for the small print on this, and I'll try and make it as big as I can. I'm going to probably fight with it a little bit, and I'm going to read it through to you, okay? But it's a good example, and I really only had it in this hard copy format, and the scanning is not the greatest thing in the world. Okay, so I'm going to read it to you because it's a really good example, but the print is bad. But let's just take a look. The city of Lawrence United Way received a donation of a vehicle from a concerned citizen on December 1st, 20X1, who directed that the vehicle was to be donated to the Lawrence Daycare Center. So what's happening? United Way is the recipient, the daycare center is the beneficiary, right? Okay. Now let's see what they tell us about how the donor set this up. The donor went on to stipulate that the Lawrence United Way could use the vehicle for a period of 1 year prior to the transfer. So the donor gives the vehicle, says, hey, you can use it for 1 year, but after that you have to give it to the daycare center, right? Okay. And so the vehicle had a fair market value of $9,000 and remaining useful life of 3 years. The Lawrence Daycare Center is a United Way organization, but does not have the ability to influence United Way policy. In other words, this question is trying to tell you that United Way is not a captive foundation of the daycare center, right? They're independent. They can do what they want with that. They're independent, right? Okay, and so what happens? The United Way elects to use the vehicle for the 1 year. So think about this. They gave them a vehicle, and for 1/3 of the life, for 1/3 of the value of the vehicle, they gave them variance power, didn't they? They said you can use it for 1 year. What? For the remaining 2 years, they didn't give them variance power, right? Okay, so how would that transaction be accounted for by the United Way? By the daycare center, and I just wrote some journal entries underneath here to show you how they would account for that for each of the organizations. And for the United Way, they got the vehicle. Remember, we showed debiting asset. I said usually cash, and now this question makes a liar out of me because here it is. It's a vehicle, but it's frequently cash. Okay, but we debit the asset, vehicle, for $9,000. We credit contribution for $3,000. That's for the 1 year of which they were granted variance power. They can use it, right? And for the what? For the remaining 2 years, $6,000, we credited a liability for that, didn't we? Okay, then what? Then when you get over to the beneficiary, the daycare center, since they know they're going to get the 2 years that are left on that, they debit a receivable for $6,000 and credit contribution for the $6,000 for the part that they know is coming to them from United Way, right? Okay? Okay. That's right. It meets the definition of an asset. What's the definition of an asset? What's the definition of asset? Come on, guys, you're getting to the stage in your career now where people are going to expect you to know this stuff, right? Definition of asset is what? Future economic benefit, isn't it? Right? Does the daycare center have future economic benefit? Yes, they do. So they set up the asset, and we're instructed by the standards to do what? Go ahead and take the contribution at that point, right? Okay? Okay? Now, if you look at the choices here, notice that the choices are consistent with the journal entries that I wrote here, and that what? Lawrence United Way will take a contribution, and it comes into the unrestricted category because they're going to use that vehicle this same year, aren't they? Right? So it's going to come in as unrestricted, and then they'll probably take some sort of depreciation expense for the 1 year against that, and that will zero out by the end of the year, right? For what? For the daycare center, they're showing the contribution on the statement of activities as temporary restricted because they're not going to get any of that benefit until what? Until next year, right? So they show it as temporary restricted. Okay? Question? All right, good. Let's go ahead and let's take a look at how we will account for investments. How we will account for investments. Now, in commercial accounting, we are told to categorize our investments into one of three categories. Anyone remember what those categories are? Huh? What of the there are three categories that we are told that we should categorize our investments into? Trading is one of them, right? How do we handle trading securities? Huh? It is a current asset. That's correct. We treat trading securities as current asset. How about if there's increases and decreases in the fair value of that investment? What should we do? Good. We recognize a gain or loss by doing what? Debiting or crediting the security. If it was a gain, let's say we would debit the security and doing what with the credit? Has to be credit. It's a gain, isn't it? Didn't I just say it's a gain? So where do you report credits that we call gains? You don't know where a credit that is a gain to an organization is reported? Okay, yes, it's on the income statement. Let me back up a little bit. Let's get a little bit of 30,000 feet about accounting, guys, okay? Accounting has two things in it always. Every transaction has a debit or a credit, right? We're clear on that? Okay, all right. Then when we report those debits and credits, we have very limited opportunities as to where we will report those debits and credits. We will either report them on the balance sheet, on the income statement, or on the statement of retained earnings. And we don't report debits and credits on the statement of cash flows. Statement of cash flows is what? It's something that is born out of the other financial statements, right? Okay? So you need to start getting into a thinking mode that if someone asks you, well, how do we handle that transaction? You're thinking debit, you're thinking credit, you're thinking what? Balance sheet, income statement, statement of retained earnings. I mean, that's what you are getting a degree here to be paid to later, to get a job to be paid to do. That's why you exist as far as your employers are concerned. Okay? All right, so you want to start thinking in that manner. So when I say, we're going to debit the asset, and I say, what's the credit for a gain? You got to say, okay, that's going to be on the income statement. Okay, gains are reported on the income statement. The debit would have been on the balance sheet, which is what I think you're thinking, for the investment, right? With me so far? Okay, now, what happens? Oh, another thing. I say balance sheet or income statement or statement of retained earnings for those debits and credits. I should have been a little more specific than that. When I say balance sheet, it's going to be either an asset account or a liability account or a what? Equity account, and that's really getting us over to the statement of retained earnings, isn't it? Okay. When I am talking about the income statement, it's either a revenue / gain or expense / loss, right? That's it. That's everything that the FASB decides to do. It's all having to fit under that structure, isn't it? So, I mean, they get in there with, these rules of this and that and the other. But at the end of the day, whatever it is they're giving us detailed instructions of what to do, that's how it is affected through the financial statements, right? Okay, so now your only job is to know where to find where FASB tells you all these things to do, and that's inside of the accounting standards codification, right? So your strategy should be to get as good as you can at looking things up in that accounting standards codification. You know the rest, right? once you read through and follow the directions. Okay? All right. Now, if that, you said trading security was one of the categories? Okay, what's the other two? Available for sale is another category of security, right? Now, with available for sale security, we do what? We have change in value. How do we handle that? We're going to recognize the gain and losses, change in value. How do we handle that? Okay, now your intuition should be telling you it's not the same as trading. Otherwise, why would we have another category other than to just upset people? Okay, so it's not the same quite. How do you want to handle the balance sheet part? Balance sheet part is the same. You're correct. We do what? We go ahead and we write that up or down on the balance sheet, don't we, as the value fluctuates? Okay, what do you want to do with the credit then? Or to say it was a gain. We debited the security. What do you want to do with the credit? We only got three choices. The credit will go somewhere to the balance sheet. The credit will go somewhere to the income statement, or the credit will go somewhere in the statement of retained earnings, I guess. But really, we don't even need to bother with the statement of retained earnings because it gets to the balance sheet, and then it gets to the statement of retained earnings. You want to debit, you want to credit the income statement? That's exactly the same treatment that we just did for the trading security. We're going to have to put a credit to our other comprehensive income. We bypass the income statement and we take that credit directly to the balance sheet as equity, and we report that as our change in other comprehensive income for the period, right? Right? Okay, that's available for sale. Is there any other category? There's three categories, so I've already told you, huh? Held to maturity. Held for maturity. Held to maturity means we don't plan to sell that. We're going to hold it until it matures, right? And if that's the case, we don't even really bother with unrealized holding gains and losses. We don't have to mark anything to market. We don't have to take any unrealized gains and losses. Okay, with me so far? Okay. Now, after going through all that, forget about available for sale and held to maturity. Not-for-profits don't have to categorize them, but they treat everything like we said trading securities. Everything is marked to market on the balance sheet, and on our statement of activities is where we report our unrealized holding gains and losses. And of course, if we sell the security, then we'll report a realized gain or loss on the statement of activities, right? Everything is treated as what? Trading security. Mark the security to market each period. Unrealized holding gains and losses go directly to the statement of activities, go directly to the income statement. Okay? So, again, we don't have to use the classification of trading, available for sale, held to maturity. We don't do that. Everything gets marked to market and gets reported on the statement of activities, right? Okay? Now, let's take a look and see what happens when we have gains and revenue that come in on these investments that are held by the not-for-profit. Okay? And so what happens? Typically, revenues and gains, the donor will tell us how to handle those revenues and gains. They'll say if there's revenue or increases in value, those revenues, say interest or dividends, right? Interest or dividends, gains in value of the security are to be used for a, say, preschool program. I'm just making that up. If that's the case, then what? Then those revenues and gains, when they come in, interest revenues, investment income, and gains, that is going to be reported under the temporary restricted column on the statement of activities until what? Until we use it the way the donor told us. Then there'll be a reclass out of the temporary restricted into the unrestricted, and we'll show the expense, right? Okay? So when we're dealing with that, typically the donor calls out how they want us to use those revenues, those gains in value, and we report those gains in value and revenue when we report them on the statement of activities under what column? temporary restricted, right? So for not-for-profit, we have to figure out whether it goes to the income statement or not, but then we also have to figure out which column of the income statement, right? And if the donor has specified how those gains and revenues are to be used, then we put it in the temporary restricted column. It's highly unusual for them to also permanently restrict the revenues and gains off of that, because now what? They gave me this thing to look at, so they may make me hold a little bit over there in the permanently restricted to protect the investment against some sort of inflation or something. But for the most part, most of that is going to go into the temporary restricted column, right? Now, it is possible that the donor will not restrict the earnings. They'll say, use the earnings however you see fit. And if that's the case, then the earnings or increases in value of that investment would go into the unrestricted column, right? Okay? So revenues are pretty easy to understand, right? What about losses in the value of that security? Decreases in value. We know we have to do what? Credit the security to bring it down. We have a debit now that we're going to deal with. We know we've already determined that debit's going to the statement of activities of the income statement, right? What column of the statement of activities? Because we have to determine whether it's unrestricted, temporary restricted, or permanently restricted, right? Now, what happens? Donors typically don't call out what to do with losses. Why not? Why don't donors say, and here's how to handle decreases in value? Why don't donors usually address that? Think about it. You're donating a stock to a not-for-profit, and what are you going to say to them? Now, when this thing starts to tank, okay, when it starts to really drop in value, this is what I want you to do. Donors don't say that. They say, here's this beautiful security that I'm giving you, and as it continues to ascend, this is what I want you to do with the money, right? They don't come out and start calling out what to do on this piece of dog when this, piece of whatever starts to drop. And so what happens? The FASB had to give us instructions as to what to do for what? Declines in value. And FASB says that we first take any declines in value to the temporary restricted column to the extent that there have been investment earnings and gains built up in the temporary restricted column that haven't been used yet the way the donor told you to. So if we had an increase of $40,000 and the donor said we have to use it for a preschool program, and we used what? We used $10,000 of it, we got $30,000 left in there, right? And if we have a loss of $20,000 on that security, that $20,000 goes to the temporary restricted column, right? Once we have used up everything that's in the temporary restricted column, any remaining losses go to the unrestricted column. So going back to the example, 40,000 is been the earnings, is built up in there. We spend what? We spend 10,000, so now there's what? 30,000 in there, and we have 50,000 saying losses. What happened? That 30,000 comes to zero, and the remaining what? 20,000 of losses would be reported where? In the unrestricted column. Okay? Now, that gets a little tougher to just sort of understand just from reading, what the slide says about that. And the slide is sort of written in FASB's prose, which is almost impossible to understand. So let's just go over and look at this. And this looks a little more scary than it is, guys. I'm going to walk you through it. Okay, so what happens? Let's just look at the question first, okay? And they say here that on January 1st, 20X1, the Bagel Conservatory received a bequest of marketable securities that was valued at $600,000, okay? So what happens? When the security comes in, when they first give us that donation, we're going to go ahead and we're going to debit marketable security for $600,000, credit contribution for $600,000, and notice, guys, it is a contribution that is what? Permanently restricted. That P means that it is what? The P means what? Permanently restricted. Okay, so we have a permanent restriction on that donation when it comes in. Now, as you read the question further, they tell us that earnings were to be used to install advanced oven systems for advanced bagel research. Whatever. I didn't make this question up, okay? Whatever. But clearly, the donor has restricted the way the contribution is to be used, haven't they? Okay. So then you come over and we say, okay, at 20x1 now, this is the same year that we had received the investment. At 20x1, okay, the value of the investment had increased to $40,000. So we had an increase in value, and they told us the increase in values need to be used for the oven research, haven't they? Okay, so let's just look at the 20x1 statement of activities that I wrote right here. This is the 20x1 statement of activities, and there's the contribution that came in what? Let me use a different color for that. Microsoft. I like how when people don't understand what's going on up here, their solution is to walk out. That'll facilitate the understanding. Okay, and so what happens? We sit here, and 20x1 contribution comes in, and the contribution is what? 600,000 permanently restricted. I'm just doing the statement of activities for 20x1, right? Right? Okay. If I look at the balance sheet, I'll get to the balance sheet in a second. Don't go to the balance sheet yet. But right here is what? 20x1 statement of activities. There's that contribution. There's that credit, right? Appearing on the statement of activities, 600,000 permanently restricted. Then what? Then we have a gain, and the gain is for what? 40,000 that they said, because it came up $40,000, didn't it? And they said that has to be used for the oven research. So the 40,000 is temporary restricted, isn't it? Okay. Okay, good. So what happens? You come over, and if you look at the balance sheet right now, the balance sheet is showing marketable security for 640,000. It's showing 640,000 because we originally debited it for 600,000 when we first got the security, and now we debit it for 40,000. I don't need to tee up the security account, do I? Do I need to tee up the security account? Right? 600, 640, so we've got the investment on the balance sheet now at 640,000, right? Right? Okay. Now, we're going to do closing entries for our proprietary accounts, for our income statement accounts, aren't we? Aren't you supposed to do closing entries for your income statement accounts? So didn't we credit contribution when we received the thing for 600,000? Okay, so we're going to debit contribution to close it, right? For 600,000? We just debit contribution to close it, right? Right? And then we had what? This gain of 40,000. Do we have to close that? Do we have to close the gain account? On what planet? You have to close the gain account. The gain accounts report on the income statement. You have to close all proprietary accounts, right? Okay. So we have to debit the gain for, what was it, 40,000? Right? We have to credit something now, don't we? Okay. Well, we're going to credit what? And I'm not going to use an income summary account. I'm just going to take it straight to net assets is like retained earnings, isn't it? Is net asset like the retained earnings? Net asset is like retained earnings, so I'm going to credit net assets P, permanently restricted, for what? 600,000, and I'm going to credit net assets T, temporary restricted, for 40,000, right? Just closing those accounts. Closing the contribution, closing the gain, right? So when I look at the balance sheet now, just finishing up our look at the balance sheet, there's the security. I'm assuming this, was the only transaction that affected this not-for-profit. So our liabilities are 0. And then our net assets are what? Unrestricted is 0. Temporary restricted is what? 40,000. I just credited it for 40,000. I'm assuming this was the only transaction that could have affected these accounts, right? So my net assets temporary restricted is what? 40. And my net assets permanently restricted is what? 600,000, isn't it? So we made it through the first year of this security, right? What's this all about? Why? What could there possibly be to think about? No, I'm serious. What could there possibly be to think about? I just showed you the whole transaction the 2 transactions as it worked its way through the income statement, the statement of activities. It came in and it got what? It got debit to marketable securities. I mean, if you want me to tee them up, I will. And that's the only other thing I could think could possibly be missing. I have marketable security. I made that journal entry, debit marketable security, credit contribution, right? Okay, so when I debit marketable security, that's a debit for 600,000. There is a balance here of what? 600,000 sitting in the marketable security account. Contribution just got credited for 600,000, didn't it? Okay, then we had a gain, right, of 40,000 for the investment. That's that journal entry right there. So I went ahead and I did what? I debit the marketable security for 40,000. That brings its balance up to what? 640,000. And I have now what? I have a gain that I've credited in that journal entry for 40,000. Right? Okay, now I'm going to go ahead from my T accounts, as we tend to do in accounting, from my ledgers. I wish I would never erase that, but that's all right. As we tend to do in accounting, I'm going to go ahead and prepare a financial statement for my trial balance, right? Okay, when I do that, I have a statement of activities. And when I show that statement of activities, I'm going to have contribution that I have to report either unrestricted, temporary restricted, or permanently restricted. And per the fact pattern of the problem, the contribution was permanently restricted, right? Now I have to report that gain, as I tend to do in accounting. When I have a transaction, I report it through journal entries. I record it through journal entries. I posted journal entries to ledgers, and now I'm pulling these from my ledgers to create my financial statements, and I have a gain that is temporarily restricted, don't I? Now I'm going to prepare my balance sheet. On my balance sheet, this is the only transaction that happened. The only balance sheet account I have right now is this marketable security. I'm pulling that off of the ledger now as 640,000, right? Okay, now I need to, as we do in accounting, have closing entries. Do you understand closing entries? Okay, when I do closing entries, I debit my revenue accounts, which we call contribution in this case, for the not-for-profit of 600,000. I debit my revenue accounts, which this one is so happened to be called a gain of 40,000. I debit that, don't I? Now in commercial accounting, you're still with me? Okay, in commercial accounting, we do that thing with the income summary, but ultimately the difference in income summary gets closed out to what? To retained earnings, doesn't it? Okay, but I'm not going to deal with income summary. I'm just going to go straight to my retained earnings. Good. In government, we call that, where are we? What chapter are we in? In not-for-profit, we call that what? We call that net assets, don't we? But I have categories of net assets, don't I? I have permanently restricted, temporary restricted, unrestricted, right? Okay, so my net assets, P, I'm putting P there for permanently restricted, right, is 600,000, isn't it? Right? And my net assets T is going to be what? Credited for 40,000, right? Right? So now I'm ready to prepare my balance sheet, right? I've finished my balance sheet off. Let's move it up a little bit. Here's my balance sheet now. My balance sheet, I have the marketable security that you see in that T count over there, which is what? 640,000. I don't have any liabilities. I'm telling you, this is the only transaction that could have affected the financial statements. These two transactions, the contribution, the gain in value, right? That's the only thing affecting the financial statements. So my liabilities is 0. My net assets are going to be what? Permanently restricted is how much? 600,000. Please don't make me tee those up. They were 0 at the beginning of the year, and when I credited them, now they have 600,000, right? And then what? My temporarily restricted is how much? 40,000. And I'm told I have to report an unrestricted. That's the way the financial statements are structured, like we talked about last time. And the unrestricted is what? Is 0, isn't it? So what is it that you had to think about? Okay. Again, guys, a point that I struggle with even with my CPA students. You got to get down the connection between the income statement and the balance sheet. That's the area that most students at your stage now struggle with a little bit, right? Because you understand all the debits and credits, and you kind of like, oh, the debits and credits, yeah, I see how that works. Yeah, I got it, debit and credit, income statement. But then the way the transactions on the income statement flow through to the balance sheet, you need to build that up. You need to strengthen that. That's the part that I see a lot of times, even with CPA candidates who are already working for the firms and stuff. I got to walk them through that. Okay, so you want to work on that, okay? All right, but that's basically what happened now in year 1 of this example, right? So we're through year 1 of this problem, okay? Then what happens? Then you come over, I'm going to try green for this. Let's see if the green highlighter will clear this up a little bit more. Okay, so we say then by year 2, right? So we're going into year 2 now. And we say by 20x2, the fair value of the investment had declined to 580,000. So what happened? Year 1, we came up to 640, didn't we? We were at 640. But by year 2, what happened? It dropped down 500 to 580,000. So we have how much of a loss? We have a $60,000 loss here, don't we? On this security. So what do? If you take a look at this entry right here that I squeezed in, we're going to, let me see, I think that one needs yellow. We're going to do what? We're going to credit the marketable security 60,000. So now it's going to be reported at 580, isn't it? Right? I credit the marketable security. How much? It dropped what? 60,000? So that 60,000 is now going to bring this down to 580. Isn't that what the security is being carried at now? Hello? Okay, the security is at 580, and I have to take the loss on that, don't I? And the rule was that what? I take the losses to the temporary restricted column to the extent that there's amounts sitting in the temporary restricted column for this particular security. And right now, we do have what? 40,000 sitting there, don't we? We got 40,000 in temporary restricted. So we're able to do what? We're able to debit loss temporarily restricted for 40,000. Okay. And we're going to do what? we're going to sit there and take loss of 20,000, and the rule was that the remaining 20,000 needed to go to what? Needed to go to unrestricted, didn't it? Right? Okay. So when I go ahead now and I prepare my balance sheet for year 2, there's my security. It's at what? 580. The liabilities are still 0. Nothing else happened there, right? Okay. The what? The temporary restricted, let's do that first. The temporary restricted was at 40,000. Now it is what? Now it's at 0, isn't it? Right? And what? The unrestricted was at 0, but we just took a $20,000 loss on that and closed it out to unrestricted. So 20,000 now unrestricted is now negative 20,000, right? And permanently restricted, nothing happened to it. It started out at 600,000. We haven't made any journal entries to it, so it stays at 600,000, right? So if you look at sort of the solution to this problem, if you can sort of find it in this mess, the solution is what? Permanently restricted is 600,000 as a result of this. My what? Temporary restricted net assets are now 0, and my what? My unrestricted net assets are now a negative 20,000, aren't they? In this situation? Okay. Now, this problem assumed that the not-for-profit, the bagel research, whatever, didn't use any of that 40,000 for the advanced oven research, right? If in this problem they had used 10,000 for advanced oven research, then there only would have been what? 30,000 available when that $60,000 loss hit, and what? 30,000 of that loss would have been in temporary restricted, and the remaining 30 would have had to gone to unrestricted, right? With me so far? Okay. Same fact pattern. Let's put a year 3 in there. Year 3, the investment comes back $30,000. So now this investment comes back $30,000, which is what I just said. Comes back $30,000 that next year, right? What do? The first 20,000 of that gain will be reported in the unrestricted column because we have to put back what we took out of unrestricted from year 2's losses. And then the remaining 10,000 goes where? Goes to temporary restricted. Now we got 10,000 sitting in there, don't we? Which we can use for oven research or whatever, or leave it there and what? Get it to absorb future losses, right? So if you're managing a not-for-profit and you get an investment in which the donor's got all up in your face and says, I want the earnings to be used, and you got to protect this permanently restricted investment, it might be wise to do what? Let a little bit build up in that temporary restricted column. In fact, maybe let a lot build up. Say, okay, well, I'm not going to use anything for the oven research until I'm pretty sure this thing's not a dog, because what's happening? If you don't do that, your unrestricted net assets are going to start to dwindle, right? And you could have other donors that start to sit there and say, hey, I'm giving you money, cash, to cover that stupid investment that you keep. I'm not here to, ride off the coattails of that 600,000. You mean to tell me I got to keep giving you money so that you can protect that initial investment? No. Clear out that unrestricted. Get some positive action going in there, and then I might give you an unrestricted contribution. Otherwise, I'm not going to do it if it's looking like, what, all the unrestricted money you just blow somehow. And it could look that way, right, if you didn't understand, well, we got this permanently restricted investment that we got to take the losses to unrestricted, and we can't get rid of this thing, right? Okay. Question? Okay, good. Let's go ahead then, and let's take a look at. It would really depend on what the donor said. I mean, if the donor said that he was to buy a picture, then that money would have been temporary restricted and he would have met the restrictions. So I don't know. It depends. But if the donors gave unrestricted and the not-for-profit decided that that was within the charter of the not-for-profit to spend that money that way, then they spend the money that way. Okay? Now, they can't spend it for personal uses, though. In other words, they can't sit there and say, well, I can go buy myself a brand new Porsche now and ride around, and carry my friends around to parties. That would be something that would be a violation of the contribution. You could potentially have to refund it, return it. Instead, state regulatory entities would probably come down on you for that. But that doesn't mean that you can't buy a nice vehicle to drive the dogs around in our little example or whatever. So if you figure out how to use that nice vehicle in the context of the not-for-profit, then maybe. So you start getting into some gray area, right, as to things that are clearly prohibited versus things that some people might think, like that picture or whatever they were calling out as that was questionable, that he should have done that. Other people might argue, no, look at how popular. He's the president of the United States now, so when people see that picture, they're inspired. And maybe the not-for-profit got a lot of money because of that picture, right? So you start to get into that kind of stuff. Okay? All right, so let's go ahead and let's take a look, and we say other accounting issues, and that's a little bit of an oversell here because the only other accounting issue that we're talking about is split interest agreements. So I should probably head this what? Split interest agreement, since that's all we're going to talk about here. What's a split interest agreement? Let's say I get mad at I'm a millionaire, and I get mad at my family, and I say, I'm done with you. I don't want to have anything to do with you. All of you get away from me. I'm changing all my numbers and don't ever see me again, right? Okay, so what happens? Now I'm sitting in my mansion and I'm going, I just got rid of my family. I'm going to die alone. This is terrible. Why did I do this? But I'm too stubborn to go back to them and apologize, right? So what do? I find a not-for-profit, Save the Canines. Let's say all my only friends are my dogs. And I sit there and I say, I have what? Save the Canines, and I'm going to give the $1 million to my fortune to Save the Canines, right? And I say, look, Save the Canines, here's all you have to do. You take the $1 million, but you have to pay me $50,000 a year out of that money until I die. So Save the Canines takes a look at that situation, and they say, well, let us call it an actuary. An actuary comes in and says, okay, what year were you born? They don't even look at you. They put on a pair of sunglasses. What year were you born? Do you smoke? Have you had a heart attack? You live all by yourself, huh? You're going to die early. Okay? So they sit there and they look at those sort of life factors, and they sit there and they say, this guy's got 5 years left to live. And so what happens? They sit there, and the not-for-profit is required then to use present value accounting and figure out what the present value of $5,000 is, and the actuary will give them an appropriate interest rate for that, whatever. They use the appropriate interest rate. So they come up with the present value of what they think they're going to have to pay me. If you think you're going to have to pay somebody, something, an amount of money, that is called a, Good. That is called a liability. So they do what? They set up a liability for the present value of what they're going to have to pay out. The remainder is going to be what? Remainder is going to be considered a contribution, and it's going to be a contribution temporary restricted, because for them to have free access to that money, what has to happen? I have to die in that situation, right? So it is what? Temporary restricted. Okay, so we call that charitable remainder trust is an example of what we're getting into, and many of these split interest agreements work in a similar manner. So let's just take a look at this example. Not so much this example, I'm just showing you the journal entry. All you want to focus in on the journal entry right here, which is what? When the cash comes in, That's going to be the debit to the asset. The credit is going to be to what? The liability. That's for the present value, which you think you're going to have to pay out to this person based on the actuarial estimates. And then the balance is the contribution, which is what? Temporarily restricted, right? Okay. So you come over and you take a look at this example, which again, I apologize, is hard to read, but when I find a good example, it's hard to give it up. This is, now I can't find the original on this anymore, but let's go ahead and let's take a look at this. On December 30th, 20X1, Albert Altruistic donated $200,000 to the Carbon Museum under the terms and conditions of a charitable remainder trust. That guarantees Mr. Altruistic a lifetime tax-free annuity of $20,000 per year, and then bequests the remainder to the Carbon Museum. Bequest means when I die, you can have the rest, right? Okay, so then what? Independent actuaries have estimated that the museum's liability has a present value of $84,258. So we brought in the actuary. He looked at this guy. This is going to die in about 3 or 4 years, I guess. And what? They used the present value of that, right? For the liability. And then what? And then what should be the proper reflection of that in the financial statements. And so first look at the journal entry that I wrote here. Here's the cash that came in, $200,000, right? Right, we then do what? Credit the liability for the present value of what we think we're going to have to pay that guy out, the 20,000s, right? And then we go ahead and debit temporary restricted contribution for the balance, right? What did I say? Did I say debit? Yeah, I wrote it as a credit, but it is kind of creeping over the debit side. Yeah, credit. Sorry, credit. Temporary restricted contribution, right? Okay. Okay, good. Now, when you look at these, the choices here, you see that the correct choice was what? Increase in the temporary restricted net assets. Ultimately, that's what's going to happen, right? It'll be contribution revenue, but then we'll close that out to what? Close that out to temporary restricted net assets. Yeah. If the guy dies early, then whatever's left in the liability account will be debited and will credit contribution. If the guy keeps dragging on, hey, John, get in there and, put a pillow over that guy's face. We're tired of him. If the guy keeps dragging on like that, right, okay, then we would have to what? We've already cleared out the liability account at some point, right? So now what's our debit going to go to? Our debit would have to go to contribution as we credit the cash to pay the guy out, right? We call that change in accounting estimate. This is how we handle these, right? Hey, if things change, the actuary was wrong. Hey, he lived longer than the chart says. If we went back to the actuary and said, hey, give us a new estimate for that guy. He's still alive. The actuary would say, no, he's not. He's dead. As far as I'm concerned, he's dead. I don't know why he's alive, but he's dead. That's all the actuary is going to tell you. You can't give me a new estimate because his charts are going to say he's not supposed to be 98. This chart says he's supposed to be dead already. So I can't give you a new estimate. So what happens? They would just go ahead and what? And anyway, you don't change for an estimate. You're not supposed to do that. You just simply go forward with that new estimate, debiting the contribution until either we're out of money or this guy is dead.
I was going to ask, is there a case that maybe like he got back to his family, now he wants to like demand like, can you go back?
I reckon it would be in how we wrote the agreement. You know what I mean? It's not like there's a law that we have to follow. It's a agreement between the two parties. And so we could have stipulated in the agreement that after 2 years I have the ability to rescind the trust or something like that. Then, yeah, then it could go back after that period of time. And Save the Canine, the not-for-profit, might say, okay, we'll take a chance. What is so we got to pay the guy $20,000 for a couple of years, and then he gets married and starts a whole nother family, right? And he wants, to give this to the new family or something. I don't know. I mean, these kinds of things happen, and then we're gonna just rescind the trust, and we'll have to give whatever's left back at that point. So it really depends on the legal agreement. Okay. Question? Any other question? Okay, good. Now, when we're still on split interest agreements here, when we report assets that are held under split interest agreement trust, we have to report those as separate line item on our financial statement. So that $200,000 cash, we don't roll it in with the rest of our cash. We'd say cash held under split interest agreement trust, right? And we'll show that because there's a bit of a restriction on that cash, isn't there? So we're going to have to report that separately. The liability, that 85,000, whatever the heck it was, I forget whatever the number was, that liability for Mr. Altruistic, that's going to be reported as liability under split interest agreement. We have to call them out separately, don't we? On the statement of activities, that 115,000 contribution, it would show contribution under split interest agreement again. So we have to call out those items as separate line items when they're affected by a split interest agreement, right? Okay. Notice what? Any assets that come in, I mean, if it's cash, then it's whatever the value of the cash is. But if it was some other asset like a stock, when it comes in, it is measured at what? It is measured at fair value at the time of donation. We don't use the donor's basis. We use whatever the fair value is at the time of donation. Okay? And we've already seen how for the liability we use what? Present value, right? Okay, good. Come over and let's take a look at donated collection items. Let's say somebody gives me a painting, the original of the dogs playing poker. You ever seen this painting? It's like this famous painting where dogs are playing poker and they're cheating and handing the cards under the table to each other and stuff. Okay, so they give us the original of this famous painting, right? Probably worth millions, right? So what happens when we receive that donation? Is the not-for-profit required to put that item on their balance sheet and recognize the contribution for that? Answer is they are encouraged to, and when FASB encourages us, we know the next words are what? But are not required to. They are not required to if they meet the criteria that is on this slide. Now, the criteria that is on this slide is the same exact criteria that we talked about for governments. Remember we said Hayward had those 3 pitchforks? Where's my Hayward people? Who had an aunt that lived in Hayward? Right? So you must remember that story, right? The pitchforks, right? So there was what? There was the 3 pitchforks, the gold, the silver, and the bronze, remember? And we said Hayward didn't have to put there on their financial statements if what? If the collection was held for public exhibition, it was protected and cared for, and if they sold one of those items, they used the proceeds to what? Purchase other collection items? Not-for-profits have the same exact rule. Okay, in fact, FASB came up with their rule for not-for-profit before GASB ripped it off for governments. Okay, so what happens? We have to what? We don't have to put those items on our financial statement if the collection is held for public exhibition, it is protected and cared for, and if the Save the Canine sold that painting, it would have to use the proceeds to do what? Purchase other collection items, right? And if you meet all 3 of those criteria, you do not have to put collections, works of art, whatever, on your financial statements. Okay? Question? They can sell the painting, I suppose. I mean, the donor could have said, you can't sell the painting. You have to hold it forever, right? In which case the contribution would be what? Temporary restricted, and we would debit, I guess, painting or something. I don't know, or work of art or something. I'm not exactly sure. Historical treasures, whatever, however we want to call that out on our financial statement. But if the donor didn't specify, they said, here's the painting, and we said, we're going to sell this thing. I hate this thing. Let's just sell it, right? Okay, so what happens? If we're going to sell it, then when we receive the donation, the painting, we'd have to debit painting credit contribution, right? If we're going to, and we're going to spend the money on something else, we'd have to debit the contribution, debit the asset, credit the contribution when we get it. We're going to report on the financial statements, right? And if when we're going to sell it, we're going to use the money for something else, then what I'm trying to say is, not very well, you have to record the thing if you plan to sell it and use the money for something else, right? So at that point, you would have to debit the asset, credit the contribution, and then obviously when you sell it, debit the cash, credit the asset, the work of art, whatever, right? So you're okay to sell it. The point is, how do you account for it? And you have to put it on the financial statements if you plan to sell it. If you don't plan to sell it, then you don't even have to put it on the financial statements. So that's a long, twisted answer, which could have been answered by yes. You can sell it, but the choice to sell it is going to dictate the accounting, is the point here. Yep. Then we would credit the painting for whatever we had recorded it for. Credit the painting for whatever we had recorded it for, and debit the cash for the amount of cash that came in, and credit the gain for the increase in value. Okay, and if we sold it for less, we debit a loss. Okay? Did I say temporary? It should go on the permanently restricted. If they have to hold the painting forever, when the contribution comes in, it's permanently restricted, right? And then there'd be work of art, work of treasure, $1 million, whatever, on the balance sheet, and permanently restricted net assets of $1 million, right? Okay? Okay, guys, so what we're going to do is we're going to take the break right now. I'm thinking we should get back at, what do you say, 10 till? Okay, get back at 10 till, and we will go through as far as we can get before we have to go that one of the practice midterms. Sound like a plan? Okay, guys, I'll see you in a little while. This off a pause here, and we are going to check this thing out because it doesn't seem to be recording now. Still on. 1 second, guys. Okay, hang on. I'm going to go ahead. I'm not exactly sure